Hello, welcome back to Chapter 6. Another important topic that Chapter 6 discusses is merchandising. Merchandising is a little bit more involved, a little bit more complicated than a service business. A service business basically provides a service to its customers. If you're a merchandiser, you could be a retailer, you could be a wholesaler. A merchandiser is buying finished product from a supplier and bringing it to its place of business and then selling that finished product to its customers. Generally, there's going to be some value added in the process of getting it from a supplier to selling it to your customer. And so you're compensated for that value added through your profit. So if you buy an item at $1, you would typically sell it to your customer at some price that is going to be higher than $1. That's basically how merchandising works. It's a little bit oversimplified, but that's basically how it works. From the accounting and bookkeeping perspective, there are a few differences. For one thing, a merchandiser has one of its main assets on the balance sheet is going to be merchandise inventory. So when we purchase merchandise inventory for resale, we would debit that account merchandise inventory. So I have buy here. Keep it in mind that we debit assets to add to an asset, and we credit an asset account to reduce that asset account. So again, when we buy merchandise inventory, we would debit merchandise inventory account, and our credit would be either cash or more typically would be accounts payable. We would typically be buying on credit. Let's say we're selling on credit, so we get 30 days, let's say, of credit from our suppliers. We have our product, we want to sell it to our customers. We could be selling for cash or we could be selling on credit. Again, typically 30 days credit, and so that would be part of our operating cycle. The whole idea is to be able to sell your product and collect your cash in a sufficient amount of time that would allow you to pay your vendors and suppliers. It doesn't always work perfectly well, but that's the concept of doing business and being a merchandiser. So again, when we buy merchandise inventory, we debit merchandise inventory and credit accounts payable. When we sell our merchandise inventory, if we are using the perpetual inventory record keeping method, perpetual inventory method of keeping track of inventory, then we would credit our merchandise inventory account when we sell merchandise inventory, and we would debit cost of sales. So this journal entry reflects the sale of merchandise inventory. We are reducing our asset account because we're selling that inventory, and the cost of that item sold is then moved over from the asset side of the equation to the expense side of the equation, ultimately to be reflected on the income statement as cost of goods sold. So cost of goods sold is an expense that shows up on the income statement, and that expense is matched with the revenue account sales. Sales less cost of goods sold would give us our gross profit. And so we'll see how that works shortly. So these are two prominent and important accounts for any merchandiser. On the revenue side, we have a few accounts that are new for a merchandising operation. Of course, our main revenue account would generally be called sales. You know, we could have one sales account, or we could have hundreds or even thousands of different sales accounts. I always use the example of a hardware store. Let's say you're an Ace Hardware or some similar type of operation. You could, if you wanted to, record every single sale that your store makes as sales. Have one revenue account called sales. Or you could, if you wanted to, have as many sales accounts as you have distinct and different items in your store. So let's say you had 5,000 different items in your store. If you wanted to be able to see what your sales were for each and every item that you sell, you could have a sales account for each one of those items. That would get a little bit cumbersome and would result in a heck of a lot of work for bookkeeping and accounting. But I'm just trying to make a point. More typically, what you would find happening in that type of operation, let's say you have 5,000 different items, but let's say you have, let's say 5 departments. 5 departments, each department would be a different type of product. Let's say you have an electrical department, a plumbing department, a general a household department, and so forth. It would probably be a little bit easier record keeping wise, and would probably make a little bit more sense in terms of the kind of information that you could get on your financial statements, to have, let's say, 5 sales accounts, one for each of your departments. So it would give you better information than having just one sales account, but it wouldn't be nearly as cumbersome, and as it wouldn't require as much work as if you had thousands of sales accounts. So it's kind of a compromise situation. I hope that makes sense. What I'm trying to say is that your the revenue section of your income statement, the revenue section of your chart of accounts, is based on what you as the owner, and let's say managers as well, of your business want to see in terms of the information flow coming back to you through your financial statements. In addition to the sales revenue account, a merchandiser typically would have 2 additional revenue accounts. Notice revenues are colored red because they're credit accounts. And by the way, I don't think I mentioned this, I use blue for accounts with a normal balance that's a debit, and I use red for accounts with a normal balance that's a credit. Revenues are credit accounts, so the sales account would basically be a credit account. But these 2 revenue accounts, if you notice, are colored blue, and that's because they are debit balance accounts, and we refer to these as contra revenue accounts. There are revenue accounts that carry the opposite balance of what revenue accounts normally carry, which is a credit. These accounts carry a debit balance. So a merchandiser would need each of these 2 accounts. One account is sales returns and allowances, and this account we use to record sales allowances or sales returns from our customers. The sales discount account is very similar, and we use that account to record sales discounts that we provide our customers. Typically, our credit customers, many companies offer cash discounts or sales discounts for as an incentive for customers to pay their accounts off early. So for instance, we could offer sales terms of 2% 10, net 30, or 2/10, net 30, N/30. What that would mean is that our customer would have the option of taking a 2% discount off their sale amount when they pay us, if they paid us within 10 days of the invoice date. Otherwise, if they did not take advantage of the discount, then they owe us in 30 days from the invoice date. So 2/10 net 30, 2% discount if paid in 10 days, otherwise due in full in 30 days. And we would use this account, sales discount, to account for the sales discounts that our customers are taking that we have provided for them. So those are some of the new accounts that a merchandiser would use in his chart of accounts.